Hello, Lynn.
Hello, how are you?
I'm great, and you. So you are in the US. I'm in Europe, because somehow we can find a way to have this conversation, which is amazing, isn't it?
Yeah, it's modern, like the marvels of modern technology. Yeah.
Exactly. We tend to forget it. We're going to talk a little bit about technology at some point, and through the conversations, we're going to talk about money, about the economy, a little bit about crypto. Can you briefly start by introducing yourself and tell me about a little bit about what you do and how did you get there?
Sure. So my name's Lyn Alden. I initially was an engineer, and so I was an electrical engineer, and I would design aircraft simulation electrical systems. Eventually, I became the head engineer of that facility. We were running a facility for research purposes for aircraft simulation. And on the side, I was writing about investments on my own blog because, prior to that, when I was deciding to go to university, my two passions were engineering and finance. I ended up picking engineering, but then still wanted to find a way to, kind of focus on finance as well. So I did that on the side. I eventually sold that initial blog I had to a larger publisher, and then I started lynalden.com in 2016, which is what I run now. And eventually, that became so large that I basically had a decision to make. I had to leave my engineering work to focus on it. Um, People often ask, how do you go from engineering to finance? What I tend to do is I apply systems engineering principles to finance and especially to capital flows, because these are ultimately human designed systems. And just like any other system, there are inputs, there are outputs, there are governing logic for how a lot of this works. And so I've had success, kind of analyzing and describing aspects of the system in ways that maybe people within the system haven't kind of thought of it that way. In 2023, I published Broken Money, which talks about money, the history of money through the lens of technology, so the past, present, and future. Um, and I'm also a general partner at Ego Death Capital, a venture firm.
Okay. Okay. So that makes you an original voice within that field because I guess you don't have so many engineers, talking about economics. So I would like to start dwelling a little bit on this specific lens that you have, so that you can explain, how this is original and what kind of point of view it gives you on the economy.
Sure. I think that a handful of things that I've really focused on. I mean, initially my passion was just value investing, right? So it wasn't
Okay.
particularly employing my engineering background other than occasionally for a tech stock. Where I started to really apply the systems principles was focusing on capital flows. And so, for example, um, we have in the U.S. We have the reserve currency. And so many people focus on the upsides of that currency. They don't focus on some of the detractions of having the currency. Triffin back in the day is known as the Triffin dilemma. He focused on some of the aspects of it, but ever since his time, it's largely been ignored, and not really necessarily rephrased in kind of the current era. And so what I focus a lot on is the downsides of operating the world reserve currency, and specifically the structural trade deficits that it gives us. In addition, I focus a lot on isolating the mechanisms of monetary policy and fiscal policy that have impacts on inflation or that have impacts on the economy. Because for many years, people either thought of them as the same thing, essentially, they would kind of lump them together, or because we were in an era of monetary dominance, they would kind of focus a lot on the Fed and less on the fiscal side. Whereas ever since 2020 or so, and arguably a little bit before then, the US has entered a state of fiscal dominance where fiscal policy is much more impactful than monetary policy for several
Mhm.
reasons. And so navigating that transition, it's been helpful to have some of an outside perspective. Obviously, engineering and finance share the quantitative background. And so trying to apply some of that quantitative rigor and some of that kind of analysis as you would any sort of complex system in ways that have been very useful. And I hear from people like during the pandemic in 2020. I mean, like there are people that say Goldman Sachs or people at J.P. Morgan, they have all the research they need, but they would find that some of the research I was providing was very helpful in kind of putting it together in their mind because my research tends to, wherever possible, zoom out and tie multiple things together.
Well, we're going to go into the details and to understand, try to understand also how you describe money and what is money. But I would like to understand how you position yourself among the different schools, the economic schools, because you say you're not, Australian, not MMT, not mainstream. I would like to understand what do you take from each of these, how they influence you, and what do you reject to see where you stand in that field.
I think in terms of the economic school that would closely match with what I cover would be Austrian
Okay.
economics. Monetrism is also somewhat close there. Uh, MMT is interesting because I think they're correct on some of the mechanisms for how things work. I think where I would disagree with them is generally on human nature in a way. Um, and so I try to incorporate multiple elements of schools. I mean, one of the things I've kind of focused on, and this has been relevant for just when you kind of figure out whether or not inflation is going to hit, is a big focus on the money supply. Um, so back when the U.S. did QE for the first time, or at least the first time in modern history, which was the 2008-2009 period, some people at the time thought it would be like hyperinflationary. They're like, oh, look at all this money printing; it's gonna
Hmm.
kill the dollar. It's gonna be hyperinflationary, and it wasn't. And if you look at, say, what happened to broad money didn't really change, or at least it didn't change compared to the path it was on. It's broad money that matters a lot more for impacting price levels. And so one of the things I focused on is that during the 2020 stimulus response, I was like, a lot of people were like, oh, it's just like 2008, 2009, it's QE, it's not, everybody said it was going to be inflationary last time and it wasn't. Whereas my focus was this is QE combined with massive fiscal. This is actually getting out into Main Street. It's actually radically increasing the broad money supply. And with a lag, it is very much likely to be inflationary in the broad sense. And so incorporating some of those monetarist views has been quite helpful. And that's also an element of that comes up in some of the Austrian thinkers as well. So I generally try to take whatever's useful uh, from any
Hmm.
sort of economic thinker, and it just so happened that, generally speaking, the Austrian and the monetarist schools tend to more closely align with what I cover.
Well, it's not a perfect science, so I guess it's a good idea, to pick some things from the different schools and to try to to build up your own opinions. So QE, by the way, is quantitative easing, because I guess a lot of people that will be listening to this podcast, don't understand much about this the topic we're going to talk about. Um, so money is a strange thing, right? It's part of our daily lives. It gives us access to a lot of things, shapes our choices, and sometimes also it traps us, right? So, but it's something so central. For something so central, I would say it's surprisingly misunderstood. So I would like to start by, asking you what we're talking about, and I know you define money, and that I find it very original, as a ledger, not as a thing, but as a shared record. And you argue that money, evolves with the technologies we use to manage information in general. Can you explain this to us?
Sure, and going back to your prior question of which economic schools I like, one of
Yep.
the opening section of Broken Money, uh, what that did was when it was analyzing what money is, one of the things I focused on was combining two different schools of thought on what money is that are often in conflict, and pointing out that they're both kind of touching on the same thing. And so, on one hand, you have the commodity theory of money that comes up a lot in Austrian economics. And the thought there is that you have a bunch of different things that could be useful as money. Generally, money has certain attributes that are very important. Durability, divisibility, scarcity. You don't want to put a rapidly increase in supply, and so money is ultimately whatever is the most saleable, whatever you could bring to a market and have the easiest way of getting it off your hands for the goods and services you need. So it's basically the commodity that has the right attributes and then achieves the network effect for being useful as money. And then, kind of more recently, there's been this growth in the credit theory of money. And David Graeber, in his book Debt: The First 5,000 Years, he really popularized that view. But if people don't want to read a full book on it, there was essays written in 19, I believe it was 1913 and 1914. Um, and he kind of brought up those a lot. So this theory goes back to the early 20th century. In some ways, it goes back to the late 19th century, and basically that was the idea that money is credit. They would kind of go back and say, if you analyze hunter-gatherers, if you analyze older societies, there never really was like a lot of barter going on, and so there never really was a case where barter was happening and then money was invented to fix the barter problem. They were like, no, before we had physical money, we generally had credit. So in say a hunter-gatherer environment or something else, one person would just make a promise to someone else, and then say when they need something, they'd make a promise in the other direction. We do it today. If you go out I use the example in the book back when physical money was more of a thing. That I would say back when I was like a young engineer, we go to lunch, and someone would kind of pay, and people would just kind of mentally tally what they owe next time. Or it's like deciding who's to drive. It's like, well, you drive this time, I'll drive next time, and it's a credit system. It's an informal credit system. And of course, as you get more interconnected, you get more formal credit systems. And what I point out in the book is that commodity theory and credit theory of money are ultimately touching on the same unifying thing, the same foundation, which is that either way, it's a ledger. And so if it's the credit theory of money, especially like a state top-down credit theory of money, then you're using a shared ledger. In this case, it's literally a ledger run by the central bank and the commercial banking systems built on top of it. And that's the ledger that everyone's using. Or if you're using physical money, if you're using gold and silver coins, for example, it's still ultimately a ledger. It's just not a ledger run by people. It's a ledger run by nature. And so if you kind of put yourself like in the omniscient view, there is an objective number of answer for how many gold and silver coins are in that region. There is a true answer, even though no individual person would be able to tally how many coins exist, who has them all. Humans don't know the ledger, at least in full, but the answer exists, and it gets updated by physical possession. And so it's kind of nature running this ledger in terms of who has the pieces, how many pieces are there, how hard is it to make more pieces. And so whether it's a ledger run by the state or a ledger run by a banking system, a ledger run by nature, they're ultimately ways that humans kind of transmit around liquid value in a reasonably reliable way to keep track of debts and credits, goods and services, and all that sort of stuff.
So by nature, you mean the physical world, kind of?
Yeah, the commodity money has that physical component, and
Yeah.
one of the things that and people often assume you could technically use anything as money. If everybody used paper clips as money, then that would be money. The problem with that view is that it only takes one person to realize that something doesn't have the right attributes of money to exploit the system on everyone else. So if we all use paper clips as money, someone can be like, well, it's really easy to make paper clips, so I'll make a trillion paper clips and I'll be a trillionaire. And so that system, it's self-defeating from the start. And so basically, when you have a bunch of different physical monies competing, in the early days it was shells and livestock, and they'd have different scores on the different attributes: divisibility, portability, longevity, scarcity, all these different aspects. And eventually, as the different societies kind of came together, some of them were better than others at being money. So if gold coins and shells come into contact, gold's better money than shells. The people that have the shells cannot make the gold as quickly. People with gold have industrial techniques, and they can harvest and create a lot of shells. And so as the world kind of found each other, it settled on silver and gold as being the best monies that nature has to offer.
And also, you trace the evolution of money through breakthrough in information technology, from clay tablets to telegraphs to blockchain now. Why is that dimension so central?
Well, so because there are two parallel technical paths for money. So the first path was what I just mentioned, the physical aspect. What are we actually using as money? And so as we increased our mining ability and refining ability and all that, we would go from shells to gold. The other simultaneous tech path was basically how to efficiently transfer the ownership of that. And those are technologies that are often so basic today that we forget that they're technology. So coinage is a technology. You stamp a picture on it, you put ridges around the edges or whatever kind of anti-forgery techniques you're doing. You have a standardized purity and size, and that makes every transaction easier because you're not like weighing out chunks of silver or whatnot. You actually just have this kind of rapid medium. Papyrus bills of exchange were early technology. As humans invented paper and bookbinding, that was more efficient. As we invented the printing press, that dramatically lowered the cost of these paper instruments. And the reason that's important is because, especially throughout the Silk Road era, so all these kind of different regions trading with each other over somewhat long distances, it was dangerous and cumbersome to, have a caravan with gold and silver with you. Um, and so, in many cases, if you wanted to transfer wealth long distances, there were these networks that were popping up of money changers and kind of proto bankers where you could give them your gold. They'd give you a receipt. You go to another city that's in part of that network and you give them the receipt, and then they could give you gold in that other city. And of course, the two money changers behind the scenes would have a way of netting with each other over time. But there's certain technology involved there. They need for example, the money changers need anti-forgery techniques on those papers. And so it's basically analog encryption. So the invention of coinage, the invention of paper, the invention of analog encryption techniques, the printing press to lower the cost, all of these kind of change the nature of money over time. And one thing I point out in the book is that the biggest stepwise change that we don't think of as a monetary technology was the telegraph. Like we talked before at the beginning of this interview, how it's amazing that we're on different continents and yet we're having a conversation. And the telegraph was the precursor to that, and that was the first time in global history where that was possible. And so prior to the invention of the telegraph, information could really only move at the speed of matter. Other than like fire signals in the night, which is low bandwidth. If you wanted to even transport a ledger somewhere, you had to physically bring it with you on ship, on horse, on foot. And starting with the telegraph, so that was invented in the 1830s. The first cross-Atlantic telegraph cable that was successful was the 1860s, and so we entered this period where increasingly the world could talk in almost real time. It wasn't until the early 20th century that went across the Pacific Ocean. So by the early 20th century, the whole world was basically, we could send information in almost real time. And if you can send information, you can make a transaction. A transaction is ultimately just an IOU. But what we still couldn't do was settle final value in real time. So basically, for decades and centuries, transaction speeds and settlement speeds were roughly the same speed. Whereas starting with the telecom era, we dramatically opened the gap. And so IOUs could flow around at the speed of light across the whole world, while physical settlement of things like gold were still very slow. And so I would argue that radically changed kind of who controls money, how money works, what wins as money. And so that's kind of the era that we entered and we've been in ever since.
Wow. Okay. So there is a deep, deep link, between how fast money flows in the system, how much you can print, and the development of the world also, I guess, because all this allows humans to do things in the end, right? And you also talk about the widening gap between transaction speed and settlement speed. Why does it matter?
It matters because the bigger the gap is, the more important the middleman is. And so back in when they're roughly the same speed, if transaction speeds, things like bills of exchange and other kind of proxies for money, if they're a little bit more efficient than physical gold and silver, then people always have the option to just fall back to gold and silver if the paper system's not really working for them, if they don't trust a particular institution. The services that those institutions are providing are real, but they're still limited. Once you get to the point where money is flowing across the Atlantic and flowing across the Pacific and moving around in speeds that physical money cannot even come close to rivaling, then you become pretty reliant on whoever's running that system, whoever's running that ledger. And so starting in the late 1800s, as this system really took off, the system became a lot more leveraged. Because instead of people having their own coins and silver coins stashed under their mattress, people increasingly had bank accounts, um, and just overall global commerce was happening in much faster and much broader reach. And so one way of kind of putting it is that up until that time, when determining which monies win versus other monies, it was all about like scarcity, basically. Silver and gold beat the others because you couldn't really make more of them as quickly as you can make other types of money. But starting with the telecom era, the reason it was so impactful is because that was the first time where speed really mattered. A money's ability to move around quickly, roughly at the speed of light, was a huge advantage. And so we entered this era where bankers and central bankers were running these ledgers, and people became increasingly reliant on them compared to how reliant they were on analog technologies before that time. And that allowed central bankers a lot of flexibility, whether it's funding governments, funding wars, bailing out systems, and just deciding who gets a bailout. Basically, we built on these kind of very large structural ledgers, and that really focused power in many ways. And so we entered this more levered period, this generally more inflationary period, because when you're kind of shifting toward a more human-controlled ledger, you're more likely to increase the units. And in an older system, if one money is increasing at a fast rate and the other one's not, people are going to go toward the one that's not. But in this era, if the one that's not increasing is much slower, people kind of are either forced or at least highly incentivized to stick with the faster money, even if it's not as scarce. And so it really changed the game for what sort of monies are successful and who's going to have the kind of the most power in this era.
Okay. Um, let's talk about money, energy, and physical limits, because I think what I find strange is that many conversations related to money tend to happen in a kind of vacuum, as if it's just numbers on a screen. But a lot of people argue, or some people, I don't know a lot, but you argue that actually money is deeply tied to energy, physics, and material constraints. I would like to explore this a little bit, because I think that's very important also to understand what's coming ahead in the coming years. How would you say money is linked to the physical world?
So because money is used to buy goods and services and store our value into the future, it obviously has an interaction with the physical world. If it's completely divorced from the physical world, that's generally when you get hyperinflations. Like a country has all this, rapidly expanding ledger, but its production ability has stagnated or collapsed. Then those monies can't buy anything. In addition, physical input is historically what has been the most reliable at keeping a money scarce and honest. Generally speaking, when you have humans running a ledger, they're more likely to inflate it quickly. They're more likely to cheat, basically. They're more likely to print more of it and giving out to whoever is kind of close to those running the system. Whereas nature has these constraints that people can argue about. People can, you know, do what they can to get more of it, but those constraints are not really the laws of nature are not, you know, bending for one person and not the other. They're the same for everyone. Um, and it also just kind of goes to conflicting views of what even say those operating money systems are trying to do. And so, for example, um, basically the way that human technology works, at least so far, is that generally speaking, we get more organized, we get better at making things, we get more efficient. Um, and so we're better at making, say, textiles than we were 50 years ago. We're better at making electronics than we were 5 years ago. We get better at making something, and so you'd expect in kind of a scarcer money environment that prices of things would go down, that your wage would be able to buy you more in the next few years than it could before, because you're doing the same work roughly, you're more experienced, and yet everything else is gradually getting cheaper, not at the same rate, but at different rates. And in the current era, we have this environment where, say, central bankers are always trying to make sure prices go up. You know, many central banks have an explicit goal of 2% per year on average. Other ones have other numbers that they target, but it's that's kind of the sweet spot that they target. So even though humans are getting more productive due to various physical reasons, um, they're trying to make sure that prices continually go up. And so this creates kind of an interesting societal dynamic where we're getting more efficient, but prices are going up, and then people are kind of struggling to say, well, are your wages going up? Because some people are in a position where their wages are able to go up much more quickly, other ones are not. And so the very flexible nature of the system, in contrast to the physical production of goods and services, that disconnect is very arbitrageable. So basically, there are those who control it. They're always in position to arbitrage it, and then there are other ones that are kind of just subject to it. And we kind of see this in different environments. I mean, um, I mentioned, I think before the call, that I spend part of the year in the U.S., part of the year in Egypt. I live in both countries, and you have very different environments. In the U.S., on average, we grow money supply by about 7% per year, um, and so that puts a pretty strong burden on wage earners to try to keep up on that treadmill. Because if they're not getting sufficient wage increases, they're being diluted. They're getting a smaller share of the network than they were last year and the year before. Um, in Egypt, the money supply is growing by generally 20 to 30% per year, pretty persistently. And so what that means is that all these wage earners, all these small business operators, they're constantly trying to increase their wages, increase their prices, generally unable to do it at that speed. And so all these different entities are getting diluted at a faster rate compared to the broader whole. And so that kind of disconnect where the ledger is inflating very quickly and the physical things capable of being produced and bought and moved around is not growing nearly that quickly. And that, the societal disconnect that can happen from that is dramatic.
Well, yeah, you have some goods that got cheaper, like garments or electronics. So why do things necessarily get more expensive while other things get cheaper despite inflation?
Yeah, because there's different rates of productivity growth for different sectors. And so, going back to the numbers I mentioned before in the U.S., because money supply is growing at about 7% per year, if something is getting more efficient at a rate more than 7% per year, then generally speaking, that price will go down. And so electronics, because we get on average, at least over the past several decades, we've gotten double digit more efficient at making electronics. Moore's law is say doubling every 2 years, for example. We get radically more efficient at making electronics, and therefore, despite an inflating money supply, the price for a given quality of electronics goes down because we're just so radically better at making those than we were 5 years, 10 years ago. Textiles are interesting because, to my prior point, textiles in the U.S. or Europe, they're generally flat to down in terms of nominal prices because we've gotten more efficient at making them. We've generally offshored them to very cheap labor regions. So there's all these kind of arbitrage or efficiency gains keeping them down. In Egypt, they're not getting cheaper because the money supply is growing by 30% per year. And so in Egypt, the price of garments actually goes up because the money supply is growing more quickly than even our efficiency gains at making textiles. And you can kind of rank things in terms of how much better we are at making them, and we can see that impact on prices. So, for example, waterfront property, we're not really any more efficient at making that than we were decades ago. So waterfront property roughly goes up in line with the money supply growth over the long term. Then you have things like gold. We're moderately more efficient at mining it, but not radically so. You look at oil, you look at hospital services, anything that still involves a lot of individual human labor. These things we're not like radically better at making, so they tend to be the more inflationary things. And then when you get to things like agricultural goods, when you get to textiles, when you get to electronics, when you get to plastic toys. These things we've got over the past several decades, we've gotten so much better at making that the rate of that has actually equaled or exceeded in many cases the money supply growth. So we're able to have price deflation in those categories,
Okay.
but not others.
Well, since the early 70s and the end of the gold standard, in Bretton Woods agreements, we can basically print money out of nothing, right? There is no direct link with the physical world, in theory. And do you think that that's why this idea that there is a link between, at some point, between energy, between material goods and money has been forgotten? And I just want to understand, how much, is there a limit to that? Is there a limit to how much money can we print without, having to face some kind of reckoning? Because we are in that situation now where there's a lot of debate on that.
Well, so, back in a scarce of money environment, it would take labor and energy to get money out of the ground. And so that would restrict how much it increases and
right?
Keep it tied to to the physical world in some way. Now we're just running basically money in spreadsheets. Now, where the limit comes into play is more about who has a share of it and who doesn't. So, for example, if tomorrow we just basically say took the dollar or the euro and said, well, we're going to 10x the number of units. So everybody, whatever your bank account is, it's 10 times more. Everyone's wage just goes up 10 times starting tomorrow. And price of every good is now has extra zero on it. That is basically just changing the unit, right? So it's not like everyone's share is changing. It's just like this abstraction is changing. Where it becomes more meaningful. So the prior point, in that sense, there's no limit to the number of units that can exist because that's mostly an accounting thing. Just what are we treating as our unit? If you denominate things in grams of gold versus ounces of gold versus kilograms of gold, that's still the same amount of gold ultimately. Where money printing becomes an issue is when, and this is how it always is the case in practice compared to that thought experiment, where the number of units is increasing, but they're not being distributed in any sort of fair way that aligns with the type of work they're doing or the type of material impact that they're having. And so, for example, during the, say, 2020 pandemic, using the US as an example, different countries all did different levels of printing, different types of fiscal stimulus. In the US, we printed a bunch of money. Houses got stimulus checks. Certain corporations got multi-billion-dollar bailouts. A lot of small businesses got bailouts of $250,000, $500,000, in many cases over $1 million. And when they kind of tally that up, the average household might have gotten $6,000 or $7,000. And if you look at how much printing happened per household, it was like $50,000. So it's like, where did that all go? And it's like, well, a lot of that went toward big corporations. A lot of that went toward wealthy small business owners. A lot of that went toward banks. A lot of that went toward all sorts of other stuff beside the kind of the end user. So basically, if you create a lot of money, there's that Cantillon effect. We create a lot of money. The early kind of adopters, the early ones that get their hand on that money first, tend to benefit more rapidly. And then as that money diffuses out into the broader system, those who acquire it less, it's generally worth less by the time it gets to that point. And that's in large part why in the US and to some extent elsewhere, there's been this lagged effect of price inflation. So print a lot of money. There's not necessarily immediate price inflation, especially if we're all locked down or whatever the case is. Money goes out in various unequal, kind of centrally mandated ways.
Like stocks,
It plows into stocks. It plows in, if you real estate went up, gold went up, Bitcoin went up, all these things go up. Disproportionately went to those that were already wealthy. So it just goes out into the system. And then because now it's circulating more, there's more, even people in the middle class have some more buying power, at least in units. So they start buying things that of course runs up into the real world, that we don't actually have more goods and services, even though we have more money. And so prices start going up. And those who basically got money later, like, through wage increases and stuff, by the time they get more money, the money's worth less because it's already circulating a lot more. And so one of the things that money printing does is it's this very opaque way of redistribution that people have trouble measuring, have trouble seeing, and yet they're still facing the consequences of.
So this is what happens when monetary claims grow faster than the underlying energy and resource base, or is it something again different?
Yeah, that's the key threshold that really makes a big difference. And there's a couple things that happen at that point. A really big one is that we can think of debt. There's two types of main debt in the world. There's one type of debt that is like highly productive debt, which is, if I'm a student, I want to get a degree that's going to increase my earning power. I might take out debt, get educated, increase my earning power, and then pay off that debt in a few years. If I'm a business or I have a business idea, I might take out a little bit of debt and expand my business with a high return on investment and then pay the debt off. These are kind of high impact or high return types of debt. And then there's arbitrage debt, which people or entities just have primarily for the sake of shorting fiat currency. And what I mean by that is, if you look at a major corporation, whether it's say Nestle or Coca-Cola or Procter and Gamble, these big multinational corporations, many cases they've been profitable for decades in a row. Never had a year without profit. Billions of dollars or euros in profit. And when you look at their balance sheet, they might have 10 billion or 20 billion or 50 billion in debt. And the question is why? And the main reason is because they can issue bonds, or at least they used to be able to. They issue bonds at 2% or roughly, very low numbers for decades at a time, and they can use it to buy back their own stock. They can use it to pay dividends. They can, use it for things that are going to earn them more than 2%. And so they're basically shorting the fiat currency. Another thing we see is, and more so in the US and Europe, is that it's very common here to have these 30-year mortgages that are fixed rate. So even as interest rates go up or down, the mortgage is locked at the initial point the entire time. And so, anyone who enters a money printing era where they own a house, they have a fixed rate debt attached to it, and then money supply goes up dramatically, well, their mortgage got inflated away, but their house is still somewhat scarce. And so they earned a lot of home equity just because they locked in that interest rate at an earlier time. And so when money supply grows faster than the resource rate, with kind of, especially if there's artificial low interest rates, there's this incentive to take out arbitrage debt. And so it rewards those who have very cheap access to arbitrary credit and punishes those who do not. So that's one big factor. Another thing that's often overlooked, because when people talk about inflation or money printing, they almost always first think about savings, people's savings getting eviscerated. The other really big thing is earnings. So basically, by money printing, you can affect every contract in the country. And so, let's say Egypt again, right? So Egypt, everyone has a wage. Small businesses have prices for all of their goods or services. And if you can just dramatically print a lot of money, you kind of put your thumb on the scale of every one of those contracts. And for most contracts or prices, there is an inertia. So the status quo has some stickiness to it. It takes effort to change the wage or the price versus just letting it be where it is. And so in many cases, if you have an inflating money supply rapidly, there's a lot of pressure on, say, wage earners to go to their boss and say, look, I need a wage increase because everything's getting more expensive. And if you're the business owner, we're like, well, why are you more valuable than you were last year? And you have to then say, well, I mean, I'm not, or I'm a little more experienced, but mainly it's just the money supply keeps growing. I need my fair share of it. And in many, especially rapidly inflating environments, it's very hard for wage earners to keep every single year reliably getting their share. And instead it kind of siphons toward the top. And because that kind of inflating money supply naturally benefits the payer versus the payee, or the one that's in a position to try to renegotiate. And so there are certain thresholds that really matter because they dramatically impact who has power in a given society. And how much debt's going to exist and what type of debt's going to exist and whether or not debt users are going to get greatly rewarded or not.
So the closer you are from the emission, from the core of the system, the easier it is to benefit from it, right?
Exactly. Yeah. So, and basically, if you have cheap access to credit, long duration access to credit, you're in a position to keep shorting the currency and buying scarcer assets, while those that are not are they're on the more punishing side of inflation, and any credit they can access is generally very high interest rate, and so it rewards kind of arbitrageurs,
Mm-hmm.
and this is something we see around the world.
I want to take a step back. In simple terms, how do you define what debt is? Is it just a kind of financial tool, or something deeper, like our friends, Nate Higgins would say, like a claim on future money, which means a claim on future energy and resources? How do you see that? How do you frame that?
Yeah, debt. I mean, there are different types of debt, and ultimately, they're a claim on future resources. And they can arise in different ways, ranging from the informal to the formal. So, in a very informal sense, one neighbor or friend will do, favors to someone else, and generally just socially expect that if they need help in the future, that they can ask, and people would reciprocate. Then you can formalize it more, and you can say, well, I'll lend you produce now. Here's, but I want claims that I can come back and get something from you at a later date. And then, of course, when you have the rise of banking, when you have the rise of governments, you have kind of just formal, methods or laws for how these are constructed. Um, and so, in Babylon, for example, the famous code of the time, it's like 4,000 years old now, and they had this kind of list of laws around how debts are created, discharged, serviced, that sort of thing. So this goes back thousands of years. And in the current era, again, it just ties into the ledger system. So we have this underlying base ledger for what money is. Then we have a series of ledgers for who owes what to anyone else, and it extends globally. One of the things I'd like to point out is that part of the reason why the dollar is the global reserve currency is because it is the currency that's used for the most cross-border debt. So it's not just what countries are using as a reserve asset. It's a country, a corporation in Brazil might borrow from a lender in France, and instead of using either of their currencies, they'll often use the dollar as the unit of account, and so that's debt owed. And so ultimately, it's basically units owed in whatever society's underlying ledger is in the current era. And that's basically an expectation of future goods and services. Like if someone owns a bond, um, on the surface, they're expecting back a number of monetary units in the future, but really what they're expecting is to increase their purchasing power, or at least maintain their purchasing power to buy goods and services in the future, whether it's for their retirement, whether it's for their business, whatever the case may be. They're expecting that the underlying value is going to be there.
Okay. Well, then big question for today. What happens when the volume of debt grows faster than the real economy that is supposed to support it?
At that point, you're at risk of default, and defaults are often hidden. And so generally, when you get very high debt levels, if you're an entity that cannot print, you're at risk of default. And so this happens to households all the time. This happens to businesses all the time, and it happens to emerging market countries that take out debt in a foreign currency, usually the dollar, that they can't print. However, it can also happen to countries that issue their own currency, except that instead of happening through default, it happens through debasement. So they basically default on the purchasing power of the debt that they owe, rather than default nominally. So they say you get all your units back, the number of units we promised you, except those units are going to buy half as much goods and services as they could when you lend us this money. And that's part of why inflation is so successful for those that kind of use it is because it defers the consequences. And so, like right now, people are debating of who caused all the inflation, and that's partially because it gets deferred compared to the initial actions. Whereas if you're taxing things and spending things, that's more upfront, that's more immediate, that's more transparent. Whereas growing debt very quickly and then having some sort of shock to the system and then printing a lot of money to support the debt to make sure it doesn't collapse, and debasing people's savings at a very kind of uneven level, that has major impacts, and that is a default of sorts, even though it's not often treated as such. And it's often happens not under the watch of those that build up the debt in the first place. It happens later.
So why some economists say that debt is not a problem as long as productivity and GDP continues to grow, and you agree with that?
I disagree with it, but what they're saying ultimately is, when you look at, it goes back to my prior point, like why do textiles not get more expensive?
Mm-hmm.
And it's like, well, because we're getting more productive at making textiles at roughly the same rate that we're making money. And so textiles, at least on the surface, are not really going up in price. And so if you're just kind of overseeing this ledger and the money supply is growing a lot from their perspective, they're saying, well, if goods and services are growing at roughly the same pace, or at least close to it, you'll have pretty minor price increases, and people will be pretty satisfied with that. And there's truth to that. I mean, people, when things are going relatively smoothly, it's fine. The part where I would disagree is that under the surface, there's still an underlying arbitrage happening the entire time. And so it's still rewarding those that are closer to the center of the system and punishing those who are at the periphery of the system. And then, that runs for a period of time, and then people wonder why there's rising populism. So the same people are saying, no, it's fine to keep growing debt, it's fine to keep growing money supply, it's as long as you're doing it at this moderate pace. But there's this big sucking that's happening from those that are not arbitraging the system to those that are in a position to do so. So in the U.S., we have waves of rising populism. In Europe, there are waves of rising populism. They take different forms, but they're ultimately the same thing. And it's a growing pushback against very slowly accumulating imbalances in the system. And though I generally find that mainstream economists and policymakers very much underappreciate those cumulative imbalances that build up, even during what otherwise seems like a pretty well functioning system.
Would it be a good idea to stop, printing money though? And I refer to what you're saying about the train. When you often say nothing stops the train. What is it? What is this train, and why cannot we hit the brakes?
So the train, when I use it in the main context, refers to U.S. fiscal deficits. So basically, the U.S. large, in that context, because every country is a little bit different.
Okay.
But large U.S. fiscal deficits are not going to stop anytime soon. When we take it more broadly, what it ultimately means is that the way that modern systems designed, and this is now international, total credit can't really go down. The system that we operate now is designed in such a way that it's, depending on what country you look at or what system you're looking at particularly, but it's all, especially in developed countries, it's all in the same magnitude. Like the dollar system is levered to 20 to 1 right now. So there's more than 20 times as much IOUs, so debt claims for dollars, as there are base unlevered dollars. The euro is similar, the yen similar. All the major developed currencies have a similar kind of magnitude. It can differ a little bit. And basically what that means is that there's no clean way to delever the system. And so even a tiny reduction in total credit starts to break everything, because they're levered, 20 to 1. Back in the global financial crisis, the U.S. was levered 50 to 1, which is why even a 1% decline in credit was like intolerable.
Can you briefly explain, what it means to be levered 50 to 1? Because I think a lot of people don't get it.
Sure. So when you have a bank account, you have a claim on euros or dollars or whatever your bank account's denominated in, and that is fractionally reserved. So the bank owns a bunch of assets, mainly loans and securities. Then they own some base layer money, and they owe you a certain amount of money, even though they don't have all the money. In addition, on top of that fractional reserve commercial banking system, there are securities, so bonds, basically. Tons of bonds outstanding. Nestle will have bonds, and they'll owe bondholders at a certain date. Governments will owe bondholders at a certain date. So German Bunds, for example. And these are all IOUs that are ultimately for base money. And in the current system, what base money is the direct liability of the central bank. Because that's the kind of the axiom of the system. So back in the older day, that would be gold. Today, it's the central bank. That's basically the foundational ledger that all this is built on top of.
Mm-hmm.
And so you have this ledger. They've got a number of base units that can change over time. You've got commercial banking systems that are fraction reserved claims for the same base unit, and then you have all these securities, bonds that also represent claims for that unit. And if you tally up how much deposits there are, so people that think they have a certain number of units in their name, and then you add bonds as well, a given developed market, using the U.S. as an example, but again, other ones are kind of in the same ballpark, is currently about 20 to 1. So there's like 20 claims for currency units, whether for each unlevered base central bank unit. And that works most of the time because there's velocity of money. So only a percentage of bonds are coming due at a given time. The profitable entity is able to pay them off. That things shift around, but every once in a while it breaks. It broke in 2008.
And it's
it broke
based on
during the
trust
year.
also, right?
Yeah, trust in the system, and then occasionally that trust completely melts down. So in the U.S., it broke during the global financial crisis. In Europe, there's the European sovereign debt crisis. Then, of course, there was COVID, and if cash flows dry up but all the debt still exists, what happens? You print a lot of money, and so that's kind of this circulating thing that happens. And the hard part is because it's so levered, they can never really let it just deleverage. If you go back to an older time where the system might have been levered 2 to 1, and there's an economic shock, and it's like, well, people are going to default, and that's that happens, and it's not the end of the world. But when you're levered 20 to 1 or 50 to 1, it cascades through everything. So even like a 1% reduction in total credit just starts, everything's on fire now, basically. And that I generally argue that's an artifact of the current system, where IOUs move around at the speed of light, more or less. They've completely decoupled from anything physical. So they're operating their own kind of arbitrary base units. There's some rules for how quickly they can increase those to try to maintain some degree of trust. Then you have all this commercial fractions or banking built on top of it. And again, there's rules there that kind of slow down how much IOUs can be made, but they're still increasing. Then you have securities built on top of that. And it's this very, very centralized, fragile system. And every maybe once or twice a generation, it faces some big shock, some big money printing event, and then that has uneven outcomes. So some people are the recipients of that money printing. Some people are negatively impacted by that money printing because of this very levered system that we've built for ourselves.
Okay, I guess most people don't realize that we have that lever thing, and that there's only one people that can get its money on the bank account out of 20 if things go fast.
Yeah.
Small question on the side. The idea of eternal growth is at the basis of our system today. This is what our trust is built on. What do you think of that?
Well, so I think obviously eternal growth, especially if you're confined to one planet, it runs into constraints. And in a debt-based system, the problem is that it's designed with the assumption that it always grows. So if you're levered 20 to 1, you can't have a bad year, basically. And whereas if you're running an equity-focused business, if you're running a business that produces cash flows and you're unlevered, you could have a good year, You could have a year that maybe your income's cut in half, and next year it's good again. It's not the end of the world, and you don't have to constantly grow. Whereas if you have debt and debt interest, and the whole thing's very levered, every year you have to grow. And there are some types of growth. I mean, there's multiple different avenues of growth. So some growth is in efficiency. So for example, it takes less electricity to do a given computer computation than it did 10 years ago because all the transistors got smaller, they got more efficient, and so with the same size chip and the same amount of electricity, it can do say 4 times more computations. That's a type of that's the closest you get to a free lunch in terms of growth, because you're not using more resources, you're just using the resources more efficiently. Um, but there are atomic limits for how much computation you can get in a given unit of electricity or a given physical space. Or actually Moore's law is kind of running into those, for example. But that's an example of something that you can get a lot of growth in with pretty minimal consequences, at least for a while. There are other types of growth that are hard. I mean, if you live in a hut and then you want a house and then you want a mansion, it's more material resources per person in a world that's has constraints to it. And then of course at a certain level you can use dramatic resources. I mean, if you fly around in a private jet, for example, using tremendous resources for yourself, and if everyone did that, the numbers don't work, at least in current technologies that we have or for foreseeable future. And so a debt-based system is ultimately unsustainable, and has that constant growth mindset and that fragility mindset, or that fragility flaw, which is even a temporary shock to growth is unacceptable when you're levered 20 to 1 or so. And so that's a fragility of the system.
Yeah, not a small one, I would say. Because at some point we're going to hit a wall, right? And a lot of people are saying that since the real economy depends on energy and resources like oil, we're going to hit the wall in the coming decades, I guess.
Yeah, and I think, there's a challenge there because people often usually the wall is a little later than what people think, because people often underestimate human ingenuity. So people thought the wall was going to be a couple decades ago, and it wasn't. But without some sort of radical breakthroughs, we are going to run into more constraints. We live, people tend to have a recency bias. So we live in this time period where human population grew very quickly. And basically a bunch of things happened at once. We discovered hydrocarbons, then we harnessed hydrocarbons, we discovered electricity, we used that. We started to pump water around, which increased our sanitation. We were able to make tractors, which able to make it so that instead of like 70% of people working in agriculture, we could get far fewer people to work in agriculture. They could start building machines, they could start finding medicines, they could do all this sort of stuff. So we have a rapid increase in longevity, rapid increase improvement in childhood living to get to adulthood. We have all these kind of radical improvements. So our population explodes. Our population goes up dramatically. In the future, it's expected to start rolling over. We kind of hit like a maximum population start rolling over, and that has all sorts of on one hand that puts less pressure on the natural environment, but it puts more pressure on our financial systems, because again, a lot of these systems are designed with constant growth in mind. So like a pension that pays out from the corporation's future earnings, it assumes kind of there's more workers, there's more revenue compared to prior workers that are now retired. Now we're entering a system that's increasingly top heavy, so there's more and more retirees per worker than there used to be, and especially in Europe, but in the US as well, and Japan, and China. So yeah, all these demographic issues, and so that's a labor constraint. And then there's the real world constraint, and people often think, well, the labor constraint can be solved by robots and automation, but all of that has real world needs. That has copper, aluminum, steel, rare earths in many cases, energy, and people often label, say, solar and wind as renewable. And while solar and wind themselves are renewable, the equipment is not. So you have to refresh that that system every, call it 30 years or so. And that's a material component. And so, this is it's a challenge that humanity is going to have to navigate, I think, in the upcoming decades, which is, not when we run out of oil, but when we hit our peak in terms of how much we can produce compared to the prior year. So if we stop increasing the production of oil, let alone just oil itself, but if we just kind of start rolling over in terms of how much oil and natural gas we're able to produce and start kind of declining from there, um, that's going to have pretty big societal implications when we get to that point. And we'll see what happens with nuclear. That can extend the runway further, and there are other technologies like that that can extend it. Deep geothermal. So again, I'm always hesitant to try to give a time
Sure.
frame for when we hit the wall, because very smart people often find ways to push that wall away, but the wall's still
Still there,
a threat.
somewhere in the future. Well, it's quite refreshing to meet someone who understands economy so well and also understands resources. So thanks for that. I would like to talk a little bit about the dollar system, and also its hidden costs, because that's part of your work. Because we still have that US dollar, that sits at the center of the global financial system, right? But beneath that dominance, lies a web of imbalances, I would say, trade-offs, and also unintended consequences. I would like to unpack them a little bit. First, to understand where we're talking about, what are the main privileges and also costs of being the issuer of the global reserve currency?
Right. So the main privilege is basically that there's a lot of extra holders of the currency, and and the bonds as well. And so if we go back for a second and let's define what the reserve currency
Sure.
is before we talk about the benefits or the cons. So most money or bonds, people only want to hold it if they're going to interact with that economy. So for example, I'm only going to hold Egyptian pounds if I plan on spending them in Egypt pretty soon. I have no particular interest in just holding Egyptian currency and bonds, and that's true for 100 plus countries in the world. Nobody wants to hold, other than maybe as a brief trade if you're a currency trader or something. There's just no long-term reason to hold their financial assets. For a handful of G7 countries, there's some reason to hold their currency, even if you don't particularly expect to interact with their economy. But by far, the biggest is the dollar for that purpose. And the dollar as a reserve currency has four main things that it does with the rest of the world. So one, international contracts, the majority of them are priced in dollars. Especially outside of Europe. So obviously cross-border contracts in Europe will often be priced in euros. But for example, if South Korea is making a resource deal with Brazil, it'll often be priced in dollars. And so it's the international unit of account for contracts. The vast majority of cross-border financing is in dollars. So again, in Europe, there's a lot of euro cross-border activity, but outside of Europe, the vast majority will be dollar denominated. There's a little bit of euro denominated in other countries like Turkey or Brazil, for example, but the vast majority is dollars. And so if an entity in one country lends to an entity in another country, could be government, could be a corporation, that'll be in dollars usually. And then in addition, most currencies are not liquid when trading with another currency. And this is often just widely not understood, which is if I have Egyptian pounds and I want to exchange them for Korean won, right?
Mm-hmm.
There's not a very liquid market between Korean won and Egyptian pound. There's not a lot of people making that trade in a given day. But there's plenty of liquidity between the Egyptian pound and the dollar, and plenty of liquidity between the dollar and the Korean won. And so 90% of currency transactions have the dollar on one side of the currency transaction, because most currency trades happen between a currency and the dollar, and then the dollar to another currency. The other 10% are ones like the euro, the British pound, and a couple others. And then the fourth thing is it's the asset that central banks and sovereigns hold as long-term savings. So basically claim on future resources. They hold dollars, they hold treasuries at a much larger capacity than they hold the currencies and bonds of other countries. And that serves two main roles. One is they're trying to maintain their purchasing power, but two, they want to be able to backstop their own currencies and their own liabilities. And so if their currency gets very weak for any reason, they can sell some of their reserves and buy back some of their own currency to stop the bleeding or slow down the bleeding. Or going back to that prior point around debt financing, if if a Brazilian corporation has a lot of debt, Brazilian banks have a lot of dollar debt. If there's a dollar shortage for any reason, it's really helpful for the Brazilian government to have dollars and to have treasuries that they can say, well, okay, we'll lend you some of our treasuries and dollars to stop our whole banking system from going bust if something like a pandemic happens and cash flows dry up. So they retain those reserves for this reason. So the dollar has this really entrenched network effect, this really entrenched ledger throughout the world. Almost all countries tie into it unless they're like explicitly sanctioned. And so that's the global reserve currency. And what that means, the privilege, going back to the prior initial question for all this, the privilege is that all these entities in the world basically need to hold dollars for various reasons, because their contracts are denominated in it, because they need it for currency exchange, because they owe debt in dollars and therefore constantly need to get their hands on dollars to service their debts. Yeah, to buy oil. That's an international contract. So they need dollars. And what that does, that artificially strengthens the dollar. So it means we can run, bigger deficits and have less of a fiscal crisis. I mean, people were talking about, especially last year, Brazil having a pretty big fiscal deficit and how problematic that was. It was like the same size as the U.S. deficit relative to GDP. But the problem is there's not a lot of external demand for Brazilian currency, so it doesn't take much to cause a little bit of a currency crisis. Whereas in the U.S., because there's so much entrenched demand for the currency, it creates a much larger runway to do shenanigans with. So that's the main privilege. It basically really it empowers especially the U.S. federal government in particular. They're kind of at the heart of the system. That's why we're able to have like 800 foreign military bases and things like that. Now, the downside to the system are depending on where you are. So if you're the issuer of the global reserve currency, it might seem like there's no downsides, but there is. The main downside is that because there's all this artificial demand for our currency, it makes us fairly uncompetitive at making lower margin things. Another way of kind of envisioning it, if the whole world needs dollars, how do they get dollars? If there's trillions of dollars of dollar-denominated debt, if there's all this contracting happening in dollars, how do they get all those dollars in the first place? And the answer is they run trade surpluses with the U.S. So the U.S. is running trade deficits with the rest of the world. We're consuming more than we're producing, and therefore our biggest export is dollars, just going out into the world. So that the downside of that is we're basically hollow out our industrial base. So we're making, we're not making cars the way we used to. We're not making machinery tools the way we used to. We're kind of losing that capacity over time. We're not making steel like we used to, and we're sending dollars into the rest of the world, and then ironically, the rest of the world's reinvesting into the U.S., but not into the same places that lost those dollars. They're investing into New York. They're investing into Silicon Valley, and so we're basically deindustrializing ourselves and stuffing that value into our financial markets. And so that's the main downside for the system. For other parts of the system, like if you're on the periphery, the downside is that the U.S. and more broadly the World Bank and the IMF and kind of all these kind of parts of the system, they have a lot of control over those economies. So if you're a dollar indebted periphery developing market, if the U.S. decides to strengthen the dollar, like with very hawkish monetary policy and things like that, they can squeeze your ability to service your own debts and put you in a very vulnerable position. On the other hand, if they want to, if they find that they want a weaker currency and they want to inflate away their debt, the U.S., then they can impair the savings of all these big, wealthier surplus countries. So they basically can choose whether, who they're devaluing, who they're trying to break the debt of, and therefore have a lot of global influence because everyone's kind of tied into that shared ledger.
Well, can you explain to me what is the current administration trying to do? what do you understand of it, and what are the potential consequences locally and globally?
So the current administration is trying to tackle the structural trade deficits that have been in place for decades. Most countries, when they run a trade deficit for many years, they run into a currency problem, and that is kind of self-correcting. But because the U.S. is the global reserve currency, we've been able to run it for decades, which means there's been very gradual imbalances building up in the system. So what seems like it works on the surface is being paid for with imbalances under the surface. So we're if you live in we call it the Rust Belt.
Mm-hmm.
It's part of the country that used to be producing a lot of physical goods, steel, automobiles, machinery tools. That part, if you live there, generally speaking, you've gotten poorer over the past few decades. And if you live in New York or Silicon Valley, or these kind of more urban centers, these more financial hubs, these more tech hubs, you've done well. That's where the money's got reinvested into. So there is, and I mentioned before, when you have these kind of imbalances in the system, you get growing populism. And people are often not even able to necessarily point to what the root cause is, but they know that something's wrong. They know that something is kind of stacked against them. And so we have these kind of waves of populism. And now for the first time in U.S. politics, the trade deficit is kind of front and center for something that people that care about, as well as that the administration is trying to reduce. So they're trying to impose taxes, to make it so that it's more expensive to import things, and to try to reduce the trade deficit. The problem, I would argue, is that they're not going after the root cause. So the root cause is the dollar as their global reserve currency. Because in order for the whole world to use dollars, we have to supply the world with dollars, and we do so through the trade deficit. And what the administration wants to do is they want to keep the global reserve currency as is, but they also don't want to have a trade deficit. So then the question is, well, how does the rest of the world get dollars to use as the global reserve currency? And so that's where I would generally argue that the disconnect is at the current time, which is that we're trying to address the symptoms of the problem more so than we're trying to tackle the underlying root cause of the problem.
Let's talk about Bitcoin a little bit, because you don't just describe Bitcoin as a speculative asset or a hedge, but as a kind of foundational infrastructure, base layer for a different kind of monetary system potentially. In your view, what problem does Bitcoin solve that no other system, fiat, gold, or digital, has been able to address?
So Bitcoin represents the invention of fast settlements. So I mentioned kind of the earlier part of this interview that the telegraph opened a really big gap where we could do transactions roughly the speed of light, mm-hmm. but the physical settlement, meaning the ability to transfer irreversible value, like shipping gold to someone, was still very slow. And so you had this really big disconnect, and therefore you relied on very big centralized ledgers to make all the transactions flow around and record all that on their ledger, while the gold itself barely ever moved. And what Bitcoin represents is, a century and a half later, our bandwidth is way better, our algorithms are better, we have all these kind of additional technologies. And what that does is that says, well, now the world's connected enough where we can actually have fast settlement. Meaning that there's a way to have a system where you can send value to someone that's not on someone's centralized ledger as credit. You just sent them the ability to spend the units, and there's no way to reverse the transaction in any sort of centralized way. And so the other way of putting it is that it's basically a new foundational ledger, but instead of a central bank running it. So I mentioned before the IOU stack. You have like what is a dollar or what is a euro? It's the liability of a central bank. That's like the foundational definition. That's the unlevered version. And then there's IOUs built on top of that. Well, what Bitcoin is it's basically a settlement system and a decentralized central bank. It's this foundational system where instead of one group of individuals deciding how many units there are or who's going to get access to those units, Instead, it's this embedded code system. So people run nodes around the world. They mine Bitcoin around the world, and it all has this kind of inherent set of very hard to change rules attached to it because it's decentralized rule set. And so it's the ability to send value to someone in irreversible ways, in an open source way, so anyone can build on it. There's no authority that can stop someone from building on top of Bitcoin or using Bitcoin, um, and you can move money around very quickly. And so that's the value proposition that it offers. And the larger it gets, the more implications it has as it pushes against our existing types of money.
But I mean, two more questions on Bitcoin, because I want to understand what's the big difference for the current system, and does it solve all the issues that we have with debt and the fact, that it's centralized through the banks, and that it's so much levered overall. And also, so one point, and also Bitcoin is also very, very much criticized for its energy use, for its current volatility, and maybe inability to scale so far. How do you respond to all these concerns, and what are how do you balance the two systems?
Right. So that's an hour-long conversation in and of itself. So it's hard to summarize that. So I'll start with a couple points. One is, so it's not going to impact the big system unless it gets 10 times bigger than it is now.
Okay.
It's a $2 trillion asset in a world of over 100 trillion in broad money and sovereign bonds and all that. So
small.
Right now it's small despite being 2 trillion, which actually makes it one of the biggest individual assets in the world. It's already in the top 10. If you run the biggest stocks, you look at gold market cap, silver market cap, it's up there in the top 10. It's below gold, it's below Nvidia, but it's rivaling like Amazon and other top stocks in the world. And so $2 trillion asset, so big for an asset, but small in the grand scheme of things. It's volatile because it's a new unit, a new system bootstrapping from zero. So you can't get big without upward volatility. And anytime you have sustained upward volatility, you get leverage and speculation. So you get periods of washout and downward volatility. So as Bitcoin grows into whatever size it's going to reach, it's going to be volatile. If it does become very large and it's no longer this kind of unclear thing, and it's something that is just widely held, then the volatility starts to greatly diminish. And so that's a feature of, it's both a feature and a downside of its adoption path, that you need upward volatility to adopt. And so there's that. The mining component, and this has often been misunderstood, and this is something that I've explored a lot because of my background in electrical engineering. One statistic, for example, is the World Bank estimates how much natural gas flaring happens in the world. So for people that don't know, if you have an oil well and there's a little bit of natural gas with it, not enough to build a pipeline or otherwise you make use of that natural gas, literally what they do is they light it on fire.
You burn it.
They just light the natural gas. Yeah, they burn it. They either release it, they vent it into the atmosphere as methane, or they burn it into carbon dioxide and release it like that. And the World Bank estimates how much of that happens, and the answer is about 7 times as much as the entire Bitcoin network uses for energy. So Bitcoin network could be powered by 1/7 of natural gas flaring. And then I use that as one tangible example of waste. There's tons of hydroelectric curtailment. Mm-hmm. So there's some regions of the world like northern Norway or Canada or certain parts of South America where they just have tremendous hydro resources, and it's overbuilt because when you build big. And then it's like, well, there's not a lot of industry there in that spot. There's not a lot of usage for that. So a lot of times they're producing electricity and not using it. And that's why a lot of Bitcoin miners flock to those regions. One of the reasons China was such a big miner early on, in addition to their successful electronics, and therefore they have all that infrastructure, they overbuilt all this hydro in certain parts of the country. And during the wet season, it was basically free electricity. It's not like that electricity is being produced for miners. The miners would go and say, well, you're producing all this electricity, so we're gonna literally move our miners over to that and to start making use of it during the entire wet season until the dry season comes. And so the short answer is there's like an orders of magnitude more waste of electricity in the system, and Bitcoin mainly uses that. Now, because it's volatile, there are periods of time where it gets so valuable that you can buy almost any electricity and mine Bitcoin with it. These are these kind of brief periods that happen. They don't really happen anymore. And so Bitcoin mainly has to go toward whatever is the cheapest, most stranded energy to harvest. And that's either physically stranded, like in the case of natural gas flaring, or it's stranded in terms of time. So, for example, if you have a region like we in northern Texas in the United States, there's a ton of solar and wind capacity, and it's also a closed electrical system. So Texas is not connected to the rest of the U.S. grid in the same way that like all the other 49 states are, or at least most of them, not Hawaii, but so not connected to the rest of the continental system. And what that means is that during certain parts of the day, there's so much energy they don't know what to do with it. During other parts, they have a shortage. And so Bitcoin miners do these curtailment agreements where they say, look, we're gonna make a deal, and we're gonna have the cheapest electricity costs around. We're gonna pay you like 2 cents per kilowatt hour. And so we're gonna have a really cheap contract. But whenever there's a shortage, we're gonna be the first ones to shut off, because unlike data centers, unlike hospitals, we can shut off with no problem, and we can do it very quickly. So when times are good and electricity is flowing and there's more than we know what to do with it, they're picking it up for pennies on the dollar. But then they're first in line to say, oh, there's a shortage. Well, okay, we're off. We don't want to pay high costs for it. We don't want to disrupt anything else. So in exchange for getting cheap electricity, we're going to cut off. And so actually what Bitcoin is, especially as the volatility goes down and as it becomes more entrenched in the system, it basically just siphons off, spare capacity. Okay. And so it's pretty healthy for the system. And then to the other part of the question, which is, how can it tackle or how can it alter current things? So as we get past these waves of volatility, as it becomes larger, so right now it's still too small. It helps individuals, but not systems. So individuals, like I know people that, only got money out of Afghanistan because they had Bitcoin and were able to get it out, for example, like women getting out of Afghanistan. So, or I know a guy that fled Venezuela with Bitcoin, or I know people that can, all these cross-border things that can happen because of Bitcoin. So Bitcoin already affects individual lives, but it doesn't really impact systems yet. But if it gets big enough where it impacts systems, then basically one way of kind of looking at it is that the entire era of modern finance is based on the idea that we need central banks because they're running the underlying ledger in a way that's fast enough for the whole world to use. So gold used to be the primary ledger, gold and silver. But as we enter the telecom era, gold and silver couldn't move quickly enough. So instead we started moving claims, IOUs, for gold and silver. We invented way more many claims than we had gold and silver. We completely disconnected from them. So all those that are issuing the claims defaulted on us. And yet, unlike any other type of default, instead of going back to the initial unit, gold and silver, because we're in this very speed dependent world, we actually kept using the defaulted system. So they defaulted on the gold and silver, and we kept using the dollars and the euros, and all these other units. And so what Bitcoin is, because Bitcoin can move as fast as fiat currency, and yet unlike fiat currency can't be printed, it's this asset that you can hold and that you can send around just as quickly. And so as it gets larger and larger, I think it does start to challenge the sovereign bond market. And it does start to challenge, all these holding of assets. And it can gradually replace some of the functions of a reserve currency. You can, for example, if it gets big and liquid enough, it can become the currency or the asset that multiple central banks hold, that multiple trading pairs happen in, and that it kind of flows around the world. So it starts to challenge, I think, some of the very levered and ever inflating systems that we built that are primarily reliant on the fact that they had the advantage over gold and silver in terms of speed,
Mm.
which they don't have over Bitcoin.
So it is a potential solution to a broken system, a broken money system, to if I understand well. And just a few words on how some of the central banks or some of the countries are reacting, either through going into CBDCs or going into stable coins. Is that what is important to understand there?
So one thing, there's been flip-flopping on it. So some countries have tried to ban it and realize they can't really ban it. They can only kind of push it in the gray market, and then it sort of happens anyway. So then they unban it and try to regulate it. In addition, they have tried to do their central bank digital currencies. One of the challenges there is they kind of misunderstand the point of Bitcoin. So it's not valuable because it's digital. It's valuable because it's decentralized and secure. And so CBDCs, we can there's two different kind of paths here. So one, over the past century and a half, almost every friction in finance was solved by another layer of centralization. So if I want to send you money, it helps that we have the same bank. We can just tell the bank, take away from me, give it to you. If we have different banks, it helps that they can tie into the same central bank. And so we kind of built these like layers on top of each other. And central bank digital currencies are kind of like the final layer. It's basically just completely surveilled, completely controlled, top-down centralization. It's the most centralized you can get. Bitcoin is like an alternative path, which is that the base layer itself is decentralized and no one can print it, and therefore, increasing number of people trust it more than they trust sovereign bonds or other types of just kind of digital paper instruments. And stable coins are interesting because you mentioned the volatility problem,
Mm-hmm.
which is while Bitcoin is being adopted from worth 0 to whatever number of trillions it's going to be worth in terms of purchasing power as a network, it goes through these periods of volatility. And especially, like let's use Egypt as an example. I mean, Egypt, you have the money supply growth 30% per year. I know a physician that lives in Egypt, and he literally goes to the black market, buys physical dollars, and then stashes them in his apartment. And that's like his best savings technology. That's like what he uses for money. He doesn't need this month, but money he wants to save for 6 months or 12 months. If he goes longer than that, he'll look into gold. He'll look into owning real estate. Less liquid things. Dollars are kind of his intermediate currency, and all the frictions of getting dollars. And stable coins are ways to get dollars in ways that are more efficient. Another way of thinking about it is that a stable coin is an offshore bank account for the middle class. So the offshore bank accounts, there's a lot of overhead of running them. Wealthy people have them. And basically, stable coins use technology to compress the overhead. And so people in Nigeria, people in Brazil, people in Egypt, people in Vietnam, if they want dollars or they want an equivalent of a dollar bank account, stable coins are the technological solution for them. It's not it has limitations. I mean,
Sure.
it can still be centralized. It can still be surveilled. It can still be frozen. It can be confiscated. It's still a chain of credit to the initial source, but in many cases, they'll trust that more than they trust the local currency issuer. In addition, it's still being debased. So if U.S. money supply is growing by 7% per year, and stable coins are not paying interest, they're getting debased. But they might not mind that too much over, say, a 6-month period, because they're still getting debased less than their local currency in many cases. And so it solves that kind of intermediate money problem for a lot of people. And so it's a competitor to Bitcoin in terms of payments, in terms of near-term savings, but it's a different long-range solution.
Well, last part on the trying to anticipate, potential shocks and building resilience based on what you said. What kind of monetary or financial shocks do you see as most plausible in the next 5 to 10 years, and what are the signs we should watch for?
So I think we're in an era of fiscal dominance, which is why I use the phrase "nothing stops his train," which is in the prior couple decades, I think we've seen the peak of the private debt bubble. And the peak happened in different countries at different times. So in Japan, the peak was in the early 90s, and they started entering fiscal dominance by the 2010s. Europe and the US are a little bit behind, but we roughly hit our peak private debt in say 2008, 2009. Now we're kind of gradually entering fiscal dominance as well, which is where basically our deficits are quite large and structural, they're very intractable. They're very hard to reduce. There's demographics issues at play. There's the fact that the private sector is so levered that even small shocks are very damaging to it. So the error correction tends to happen on the public ledger as money printing happens. Now Europe has increased fiscal expenditures toward military as well. So geopolitical implications.
So the debt
and
is
so
not going down, yeah.
Yeah, debt's not going down. We're entering this period of I think I would call it sustained debasement. And so in many cases, bonds will not be holding their purchasing power for 5-10 year periods. Increasingly, central banks will look around and say, well, why should I hold American or European bonds when I can hold gold, or when I can diversify my reserves, or if Bitcoin gets big enough, hold some Bitcoin like El Salvador and Kingdom of Bhutan and UAE does. And so over time, I think the world's entering a more multipolar world where instead of just everyone kind of centralizing around the dollar system, there's increasing, multilateral agreements. So China is gradually kind of internationalizing their currency, basically saying, look, if we're going to buy things from you, let's use our currency. Europe and other countries are kind of trying to solidify their own systems. And so I think we're gradually entering a more multipolar world, a more fiscally dominant world, which means more intractable fiscal deficits among especially developed countries. I think within that 5 to 10 year period, we'll probably have another energy shock because U.S. shale oil is rolling over.
Okay.
And so I think we're going to have these
and the tech
a
bubble.
long-term. Yeah, I think we're going to enter a long-term debasement period with occasional shocks, and that generally speaking, the way to position yourself is to have scarcer, more debasement-resistant assets that are desirable.
What does it mean concretely?
I mean, I'm bullish on Bitcoin, gold, high-quality equities, and commodity type of resources, because I think we're going to go through another commodity cycle in this period of time. They need them for energy production. They need them for robotics and automation. They need them for data centers and AI. They need them for the continued industrialization of the developing world. And so I think we're going to run into a period where we're going to have another dollar bear cycle. I think we're going to have another bullish commodity cycle, and you can protect yourself by owning what is scarce assets. And I think if you're a sovereign, you're trying to figure out ways to make yourself less dependent on an external power. So we've seen, for example, Germany already repatriated some of their gold that they held in New York. Now we have more recent headlines of Germany and Italy both wanted to repatriate more of their gold. So I think we're in an era where sovereigns are reassessing how dependent they are on, especially the U.S., but just any great power. I mean, Canada is getting pushed around by the U.S. on these trade deals and saying, well, maybe we shouldn't be so reliant on the U.S. economy. Maybe we should build more pipelines to our coast, for example, so we can sell our products to other entities. And I think we're kind of, ever since especially the opening of China in the 80s, the fall of the Soviet Union in the early 90s, we had this kind of period of globalization and centralization. Everyone kind of focused on efficiency at the cost of fragility. And now all that's getting shaken up. So with Russia invading Ukraine and with the U.S. Entering a very kind of tariff-focused policy, we're entering the world where a lot of prior assumptions are being quickly challenged. And so countries are kind of in a position where they're trying to be more self-sovereign. And I think that's the era that we're entering.
And you mentioned the valuation of NVIDIA. How do you see the current, tech bubble, if it's a bubble, and maybe housing bubble? Because you can say also that housing is something, a real asset. Is it part of that category? that you mentioned?
So I mean, it depends on the country. Right now, for example, U.S. real estate on average is cheaper than, say, Canadian real estate, Australian real estate, even many cases European real estate. In the U.S., our bubbles tend to be more in our public markets, our stock markets. Whereas in many other countries, it's their property bubble that tends to be very large. That was China until a couple years ago. It was multiple countries. So it depends on what jurisdiction you're in. I would certainly advise you can't buy a scarce asset at any price, because if you buy it too high of a price, even when debasement happens, you still have overbought, you still have overpaid for that asset. So scarce assets, yet you can only kind of buy when they're at a reasonable valuation compared to expected cash flows, how many people want to own the asset versus already own the asset. With tech, I think that so Nvidia is like a now more than a $3 trillion company. I think it's going to be slow to continue growing from there. But I do think that the underlying demand for GPUs is going to keep increasing over the next 3 years, 5 years, 10 years. Now, there's occasional bubbles along the way where all these entities fight to get as many GPUs as possible before they fully know what they're going to do with them. Then they realize they maybe can't deploy them as profitably as they wanted to. So then they go a couple of years without really ordering as many. So you'll still have kind of, I think, ebbs and flows along the way. And there are other competitors that can enter the market or catch up, like AMD and some others. But I think that there's going to be a structural bid there for data centers, for GPUs, because we're kind of doing, I think, in some ways, to white collar work what happened to blue collar work in recent decades. So for a lot of blue collar manufacturing work, for example, got automated.
Yeah.
So one assembly line worker can now do the work of 10 because they're monitoring the robots doing it more so than doing it themselves. And I think that some portion of white collar work is going through the same thing, which is that these tools will allow like one accountant to do the accounting work that it used to be done by 5 accountants, for example. And so I think it becomes more about managing machines than just doing it with your own hands or doing it with your own on your own fingers and keyboard in this case. And that's going to have disruptions. That's going to have opportunities. And I do think that overall data center usage, GPU usage is going to be radically higher 5 to 10 years from now than it is now, just with shakeouts along the way.
But when you look at the valuation, do you see signs of disconnection from fundamentals? How do you assess what's happening again, like with companies? Because we tend to forget that there is an energy issue behind it. And when you see valuation of these companies versus the energy companies, it's kind of strange, right?
Yeah, I'm a lot. One of the ways that I play this is I'm long energy.
Okay.
Because natural gas is one of the fuels that's going to power a lot of these data centers. I've also been long uranium, just because between nuclear and natural gas, that's the marginal energy source that can power a lot of these build outs. And so while I have been long some of the tech itself, I like the physical, the base for it. The picks and shovels in a sense. And like I said, I do think that in the next during that time frame of 5 to 10 years, I do think we're going to have an energy shock and a kind of a reset to higher energy prices because of it.
Can central banks or governments, still act as a stabilizing force, or are they now, just constrained by the very system, they have built? In other words, like, who's in control? Like, is anyone still in control with it when it comes to this trajectory?
Control diminishes. So one way to kind of put it is that the further a country enters fiscal dominance, the less ability it has to control shocks. And so, for example, I'll use the U.S., but this applies to Europe and anywhere else as well. So back in the 80s, the U.S. had 30% public debt to GDP, and most of the money creation was happening at the private sector, so bank lending. If they wanted to control inflation and they raised interest rates, they would slow down bank lending. And while they would blow out the fiscal deficit because of interest expense on the debt, the downward pressure they would put on the private sector would be greater. The problem is that when they fast forward now to 120% debt to GDP, if they raise interest rates trying to slow down inflation while they have that much existing debt stock, they blow out the fiscal deficit at a bigger number than they slow down the private sector. And so whenever a country gets roughly 100% of GDP or higher in debt, whether it's the US, whether it's European countries, their ability to slow down total credit growth gets impaired. And so you get this kind of sustained run it hot type of environment, which is more akin to what we see in developing countries. So you get this around the margins, you get kind of an emerging marketification of major developed countries when they get this indebted. And yeah, they start running out of ways to control it. Now, the risk there is that they then often turn to financial repression. So they turn toward more surveillance. They turn to more capital controls, basically because they've lost control of the interest rate channel and they've lost control of the price lever. So then they say, well, okay, now we have to do these other things, and they can get more draconian. And so that's the risk, I think, in the next 5 to 10 years.
Okay, nice. Two last questions. Is there one piece of advice or one insight, that would like people to remember about money, power, or the future? What would it be? And more practically, even you touched a little bit on that, even if you're not a financial advisor. But what can individuals or communities actually do to prepare for what's coming? Some nuggets.
I would say the main takeaway, and this is a big topic I focused on in Broken Money, is that technologically changes, they can shift who has power in certain areas.
Okay.
And so, for example, the invention of the telegraph and all these other things, they really centralized power around money because those who could control the ledger now arbitrage that big gap between transaction speeds and settlement speeds. And that's not the first arbitrage that happened. That's just a really big one that's still relevant for the modern time. And so a lot of solutions focus on politics, where they say if you only get the right candidate in power, we'll fix this thing. Whereas any sort of political change is only temporary and local, whereas technology changes tend to be global and persistent. And so that's, I think that's why I focus a lot of my energy on identifying tech trends, and also because I work in venture capital, in some small way shaping some of those tech trends, basically funding companies that are contributing to tech in some way that I find interesting. And so I would say that's the main takeaway. And number two, for protecting yourself, one is just education. So one is watching shows like yours, and hopefully reading books like mine, or just kind of researching what's happening in the world, especially as it relates to money, energy, some of the big things of our day. And then two, I would argue that you want to own scarce assets at reasonable prices. One kind of benchmark to test is always ask yourself, am I being diluted? So don't look at things like inflation rates per se. Look at dilution rates. So if you're holding the euro and you're getting paid a certain interest rate to hold it, either in bonds or in a bank account, look at the total supply growth of euros, of European bonds, for example, and say, is my share of the total growing or shrinking, and by how much? And then you can apply that same logic to other assets. You can apply it to gold. You can apply it to Bitcoin. You can apply it to the top tier equities. So you say, is my share of this like industry growing, and is the industry itself growing, or am I getting diluted? And so I think if you kind of stick to that kind of North Star, and always, make sure you're minimizing how much dilution's happening to you, you protect yourself from a lot of the downsides that can kind of slip past over time.
Which I guess is not so easy to calculate for some sectors, right?
And that's part of why it works, is that people will focus on inflation,
yeah,
and they'll say, well, if I'm earning 3% and inflation's only 1%, then I must be doing okay.
Yeah.
Whereas the money supply might be growing at 7%, and you're getting diluted. And so there is a challenge to it, but I would say it's a worthwhile challenge to pursue.
Interesting. Thanks. Last question. 2 books that one should read while being alive. Any book.
I would say I like Lessons of History. It's like 100 pages, and it's like an attempt by the authors to summarize human history and lessons from it, like 5,000 years of human history in 100 pages.
Who wrote it?
So That was Will and Ariel Durant
Okay.
in the 1960s.
Oh, okay. That's your favorite book for now.
I would say that's a book certainly worth reading. I'm not sure if I have any one favorite book, but that I think the reason I like to mention is because it's like 100 pages.
Okay.
So it's not a big commitment, and you get a lot out of it for how little you have to put into it. So I would say it's the highest ROI book you could read in terms of having a big picture.
Good selling point. Well, and your book, obviously, I will put all the details on the page as usual. Thanks so much for your time, Lyn. Thanks so much for the insights. I will listen to it again because just to make sure that I understood it well, because it's very much insightful. But you know, there is a book if you want to dwell a little bit on this. Thanks again.
Thank you. Have a good day.